Nobody told you that the financial system was designed before you were born, not designed against you specifically, just designed the way a casino is designed. The house doesn't hate the gambler, it simply built the table. You are at the table right now. And here is the thing they never say out loud. The level you are at is not just a number in your bank account. It is a different operating system, different rules, different threats, different enemies. What destroys someone at $0 is completely irrelevant at $5 million. What quietly bleeds out someone at $5 million is invisible to someone at $50 million. The dangers change, the game changes, the players change. Most financial advice ignores this. It treats money like a single straight road where you just need to drive faster. It is not a road. It is a series of entirely different countries, each with its own laws, its own traps, and its own way of making you feel like you finally made it, right before it takes something from you that you did not know you were risking. I am going to walk you through every level, not to show you what a rich life looks like, to show you what each level actually costs, what each level demands from you, and where each level hides its knife. Pay attention to the level you are at. Pay more attention to the one above it, because the move that gets you there is rarely the problem. The move you make after you arrive, that is where most people lose everything they built. $0. Not broke. Zero. The distinction matters. Broke means the money ran out temporarily. Zero means the system never let you in. You're not behind on payments because there are no payments. There is no credit file, no income history, no paper trail that says you exist in the financial world. Banks do not see you as a risk. They do not see you at all. At zero, the first enemy is not debt, it is invisibility. You cannot borrow to start something because there is no history to borrow against. You cannot open certain accounts. You cannot get certain jobs because yes, employers run credit checks now, and an empty file reads like a red flag to people who never had to build from nothing. At zero, the trap is that the only financial products designed to reach you are the ones designed to extract from you. The payday lender on the corner, the rent-to-own furniture store charging 190% APR buried in a contract nobody reads, the prepaid debit card with 12 different fees for existing. The system did not forget you at zero. It specifically built a parallel system for you, priced at a premium. The survival move at zero is not hustle motivation. It's understanding that your first financial priority is not income. It's becoming legible to the formal financial system. A secured credit card with a $200 deposit used for one recurring bill and paid in full every single month starts building the file that eventually opens every door that is currently closed. You are not borrowing. You are creating a paper identity that the system can read. Without that file, higher income alone will not save you. There are people earning $4,000 a month in cash, no bank account, no credit history, invisible to every institution, and they are one medical emergency from the kind of zero that takes years to climb back out of. $30,000. The first salary that feels like evidence. Evidence that you are going somewhere. Evidence that the effort was not wasted. Direct deposit twice a month, health insurance through the job, your name on a lease by yourself for the first time. The trap here has a name. It's called payment tolerance. Your brain doesn't budget in totals. It budgets in monthly payments. At $30,000, you net roughly $2,100 a month after taxes. The apartment is $950. The car payment is $340. The car insurance is $180. The phone plan is $85. The subscription services accumulate to $67 before you notice. Gym membership, $45. You're at $1,667 before groceries, before gas, before a single unexpected expense. You did not overspend. You just said yes to a series of individually affordable things that collectively left you $433 away from an emergency every single month. This is lifestyle architecture before you knew you were building anything. And once the architecture is set, once the lease is signed, the car loan is locked in, the direct debits are running, the monthly number is fixed. The only way out is income up or payments down. Most people at $30,000 wait for income up and spend the next 3 years treading water. The move here is brutal and specific. You calculate your actual fixed monthly obligations, every single recurring charge, before you agree to anything new. If the new obligation pushes your fixed costs above 70% of your net income, you do not take it. You find a cheaper version or you wait, not because you can't afford the payment, because payment tolerance is the slow leak that keeps people at $30,000 for a decade. $60,000. You crossed a psychological threshold somewhere around here. Not rich, but not scared anymore. The emergency fund has 3 months in it. The credit card gets paid off. You started a 401k because the company matches, and someone told you not to leave free money on the table. The enemy at $60,000 is more sophisticated than payment tolerance. It's called social spending velocity. Your income went up. Your immediate circle noticed, not because you told them, because your zip code changed, your car changed, the restaurants changed, the trips changed. And now there's an invisible social contract that costs money every single weekend. The birthday dinner at the place nobody can technically afford, but everyone pretends is fine. The group vacation where the budget conversation is awkward, so nobody has it. The rounds of drinks where the tab gets split evenly, and you had 1 beer and someone else had 4, but the math doesn't get discussed because the math is rude now. You are not being robbed. You are voluntarily paying a social tax to remain in a group whose financial behavior is slightly above where you actually are. And the dangerous part is that it feels like living. It feels like the reward for working hard. It is not. It is the thing that makes sure the 401k never grows fast enough to matter. The move at $60,000 is not to stop spending socially. That's isolating and unsustainable. The move is to become precisely aware of what you are actually buying. Every social expense is either buying genuine connection, genuine experience, or social approval from people you are slightly performing for. The first 2 are worth money. The third one compounds into 0. $100,000, 6 figures, the number everyone announces, usually once, and then they go quiet because the reality doesn't match the mythology. Here's what $100,000 actually buys after federal and state taxes in a high-cost city. Roughly $68,000 a year, roughly $5,600 a month, which, after rent for a 1-bedroom in a city where 6-figure jobs tend to cluster, leaves you with less monthly discretionary income than your cousin who manages a distribution center in a lower cost of living market and earns $58,000 with a paid-off truck and a mortgage at 3.1%. The enemy at $100,000 is a cognitive bias called arrival fallacy. You spent years targeting this number. The targeting itself was motivating. When the number arrives and the feeling doesn't, and it won't, the brain does one of 2 things. It goes numb and starts coasting, or it immediately targets the next number as the real threshold. Both responses are expensive in different ways. Coasting at $100,000 is a quiet disaster because $100,000 in a career that plateaus is not security. After 10 years with standard raises, you are at $130,000 in nominal dollars, maybe $105,000 in real purchasing power, with a lifestyle that has expanded to meet every raise and no structural wealth to show for it. The income statement looks fine, the balance sheet is almost empty. This is the moment, not when you first hit $100,000, but somewhere in the first 12 months, where you have to decide if you are building income or building wealth. They are not the same thing. Income is a river, wealth is a reservoir. At $100,000, you finally have enough flow to start filling the reservoir, but only if you make the decision consciously, because the lifestyle will absorb every dollar you do not explicitly redirect. $200,000. The tax code starts to feel personal at $200,000, not complicated in a way that requires an advanced degree, personal in the sense that you are now in a bracket where the government takes a percentage that used to feel abstract and now shows up as a real number on a document you have to sign. The people around you, your accountant if you have one, the financial advisor who keeps calling, will start using language you have heard before without really hearing. Tax advantaged, deferred, depreciation, basis. Here is what they are actually saying. The rules of the game change above a certain income, and the people who built the rules wrote in exits for themselves that are completely legal, rarely advertised, and entirely available to you if you learn where to look. A self-employed person at $200,000 who sets up a solo 401k can defer up to $69,000 per year from taxation. Not shelter it forever, defer it to a period when their effective rate is lower. That is not tax evasion, that is reading the same document that the wealthy have been reading for 70 years. The enemy at $200,000 is not the tax rate, it is tax passivity, paying whatever the first software calculation produces without asking whether there is a legal structure that changes the answer. W-2 employees have limited options, but the moment any income is self-generated, consulting, a side entity, any business activity, a new set of tools becomes available, and most people at this level have no idea those tools exist, because nobody with a financial interest in their ignorance is going to volunteer the information. If you want to pause here for a moment and actually use what this script is giving you, save it. Share it with someone who is operating at a level where this is immediately applicable. The next section is where the money mechanics get architecturally different, and most people have never been told why. $500,000. You are not working for income anymore. You are working to avoid working for income forever. The distinction restructures every decision. At $500,000 a year, the question is not what to buy. The question is what to convert. Income is taxed at the highest rates. Capital gains are taxed at lower rates. Assets that appreciate are taxed only when sold. Assets that generate passive income can be offset by depreciation from real estate, by business losses that exist on paper but not in your bank account, by structures that exist entirely legally and are used by every person above this level. The enemy at $500,000 is not the tax bill, or the lifestyle, or the social complexity, though those are all present. The enemy is the advisor ecosystem built to harvest people at this income level. The wealth management firms that charge 1% of assets under management, which sounds small until you calculate that on a $3 million portfolio, it is $30,000 a year, compounded over 20 years, against an index fund that charges 0.03%. The insurance products structured as investments that primarily benefit the broker who sold them, the alternative investments with locked-up capital and fees layered inside fees. At $500,000, everyone around you is credentialed. Everyone has a title. Everyone has an office and a handshake and a track record they will summarize for you. The predators at this level do not look like predators. They look like fiduciaries. The move is not to become paranoid, it is to understand one principle. The person's compensation is tied to the product they recommend has a structural conflict with your interest, regardless of how much they like you. The simple version, own your index funds directly, know exactly what every advisor is charging, ask the question that most people at this level are too polite to ask, how do you get paid on this specifically, and watch what happens to the energy in the room. $2 million. The word liquid starts mattering here, not as a word, as a precise operational concept. You have $2 million, maybe in a combination of a business, real estate, retirement accounts, and brokerage holdings. On paper, you are wealthy. In practice, the question is always, how much of this can you actually access, at what cost, and in what time frame? A business owner with $2 million in enterprise value and $80,000 in accessible cash is not wealthy in any functional sense. They are illiquid, and illiquidity at this level creates a specific kind of pressure that people below $500,000 don't understand and people above $10 million have solved. The pressure of looking wealthy while not being able to move. Decisions get made from that pressure. Bad acquisitions, bad loans, bad partnerships with people who sense the constraint and offer expensive solutions. The enemy at $2 million is the psychology of the paper number. The move is to calculate and actively manage your liquidity ratio. What percentage of your net worth can you access within 90 days without destroying the underlying asset? The answer should not be below 15%. If it is, you are not building wealth. You are building a balance sheet that looks impressive and constrains you. $10 million. The problems at $10 million are problems you can solve with money, which makes them feel manageable. They are not. They are expensive and slow and require lawyers. Estate planning is no longer abstract. The federal estate tax exemption, which currently exists at a level that is politically contested and structurally temporary, means that wealth above certain thresholds passes to your heirs at a 40% tax rate on the overage. Trusts, irrevocable, grantor, charitable remainder, are not tax evasion. They are the mechanism by which every multi-generational wealthy family in this country moves assets across generations without surrendering 40 cents on every dollar. The enemy at $10 million is not the tax code. It is procrastination about the tax code. People at this level frequently understand that estate planning is necessary and delay it for years because it requires confronting mortality, making explicit decisions about family members, and sitting through uncomfortable meetings with attorneys who bill in 6-minute increments. The delay is expensive in a very specific way. Every year you wait is a year the assets appreciate inside your estate, which means the taxable value grows faster than the conversations you are avoiding. $50 million. You stop thinking about money sometime around here, not because it stopped mattering, because the infrastructure around you thinks about it so that you don't have to. There's a family office, or the functional equivalent of one. There are people whose entire job is to manage the complexity that your net worth generates. Legal, tax, investment, insurance, philanthropy. You are not making financial decisions anymore. You are making decisions about who makes decisions and what frameworks they operate within. The enemy at $50 million is delegation without oversight. The people managing your capital are not you. Their incentives are not perfectly aligned with yours. Their career risk is not your financial risk. Every scandal involving a wealthy individual who lost significant assets to a trusted advisor follows the same script. Someone delegated completely, stopped asking uncomfortable questions, and trusted the infrastructure until the infrastructure failed them.
$500 million. $500 million is not a financial position, it is a political one. At this level, capital allocation is itself a form of governance. The decision to put $200 million into a region, a sector, a technology, or a government bond market moves prices. It creates jobs or eliminates them. It funds political campaigns or withholds funding. The financial system at this level responds to you as a participant, not a customer. The enemy at $500 million is abstraction. The distance between the capital and the human consequences of its deployment can become so vast that the decision maker loses the feedback loop entirely. The factory closure that generates a 12% return optimization looks different when your name is on the building, and looks different still when you have never seen the building and will never meet the people who worked in it. This is not a moral lecture. It is a mechanical observation about the psychological cost of operating at this altitude. The people who do it well, who maintain judgment, who remain calibrated, who continue to make good decisions instead of defended decisions, are the ones who deliberately maintain contact with the non-abstract. They visit the operations, they read the letters, they preserve at least one context in their life where the feedback is direct, human, and impossible to delegate. Somewhere tonight, someone is doing the math on their phone in a parking lot outside a shift they just finished, adding up the numbers, realizing the numbers do not add up, Googling whether they can transfer $47 between accounts tonight or if it will post tomorrow. They think the problem is the number. It is not the number. The number is just the current expression of the operating system they are running, the beliefs, the behaviors, the financial infrastructure, or absence of it, that determines what the number does next. Every level in this video is an operating system upgrade, not an income upgrade, a decision upgrade, a threat awareness upgrade, a different understanding of what the game actually is at that altitude and what it will cost you if you arrive there without knowing. The check engine light you need to pay attention to is not the one in your car. It is the gap between what you know about money and what the level above you demands that you know. That gap is closable. It always has been. The system was built before you got here. You can still learn to read the blueprints.